Hi, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, a series of short videos exploring the mechanics of cost accounting. The current video is called The Challenge of Accounting for Fixed Costs 2, Inventory Growth and Income. In this video, we ask a very simple question. If you make something and don't sell it, does your income go up or down? Right? Are you richer or poorer according to your income statement? And it turns out when we use absorption costing, the answer is not so obvious. So we're going to take a look at this using numbers very similar to the ones we used in the Challenge of Accounting for Fixed Costs 1. What did we assume in that case? Here, I'll just toss this up quickly. We assumed we had a business with a 300% direct labor overhead rate, and they were considering a job, taking on a job that would require 10,000 direct labor dollars and bring in revenue of 35,000. We also assumed that the overhead, that 300% rate came about because they were expecting 125,000 of fixed overhead, 25,000 of variable overhead, all spread out over an activity base of, so that's 150,000, spread over an activity base of 50,000 direct labor dollars. So that's where they got the total 300% rate. But really, you can think about that as the sum of two rates, a 250% rate for fixed overhead and a 50% rate for variable overhead. Okay, so now we're going to keep all of those assumptions. The only difference is that we're not going to assume that we get 35,000 in revenue for the job. We're going to assume that we incur the 10,000 in direct labor. We apply direct and indirect costs for the job, but we never finish it. So it's still sitting in inventory and doesn't go into cost of goods sold. So the question is, how will our income change? If right now you are thinking, well, obviously our income can't change at all, then you are forgetting that income is determined by adjusted cost of goods sold, not unadjusted cost of goods sold. So let's create our Queen's cross with assets and liabilities on the top left and right, expenses on the bottom left. We're not selling the things, so we don't have revenues. And remember that we have I guess I'll just use that space to write down. We've got our 300% overhead rate, of which 250% is fixed and 50% is variable. And so now let's first go ahead and account for the direct labor. We're assuming this is a cash business. We've got 10,000 in direct labor, and we're going to put that directly into work in process. So far, so good. Now we are going to apply costs as well. So we've got our manufacturing overhead account, and we've got $10,000 of direct labor cost, which means at a 300% rate, we've got $30,000 of overhead that we are going to apply. Almost done. The last thing we need to do is recognize that we are incurring overhead as well. Now, remember that we incur the overhead. This 250% fixed overhead rate is really just a fiction. It's the $125,000 of total overhead that we thought we would have, spread out over 50,000 direct labor dollars. So 125,000 over 50,000, right? That's that's our 250% fixed overhead rate, but that only works for application. It doesn't work for incurred overhead, as we saw in this figure, where we noted that under absorption costing, the amount that we incur is, well, we're going to incur $125,000 up front and then only an additional 50% on every direct labor dollar, because that's really the economics of what's going on, even though we apply at a constant 300% rate. So since we have $10,000 of direct labor at a 50% rate, we are going to spend another $5,000 in our variable overhead costs. So far, so good. So far, no effect on the income statement. Right? So here's where you're saying, oh, see, I knew it all along. If you make something and you don't sell it, how could that possibly affect your income? Well, we're not done, because we have our adjustment to cost of goods sold. We have a credit of $30,000 to overhead and a debit of $5,000, and so just because of this transaction, we have created some over-applied overhead. We've got to put a debit of $25,000 into overhead to zero that account out. And where does it go? It goes as a credit to cost of goods sold. So check it out. We make something additional. Our adjusted cost of goods sold goes down. So our income goes up. How does that work? How could that possibly happen? Well, the answer is really pretty clear because of the Queen's Cross. Remember, when we first introduced the Queen's Cross, we emphasized that, if you credit cash for some amount, you are going to be, you got to balance that with a debit to something. The debits are either going up into the balance sheet, or they're going here into the income statement. If they're going up here, and look at this, we spent $5,000, but we debited work in process for $30,000. We tucked $25,000 of fixed costs into the balance sheet, so they're not on the income statement. We've had to take them out of the income statement because they can't be two places at once. This is a huge problem for businesses with high fixed costs and inventory that is durable. So, for example, auto manufacturers. At an auto company, at the end of the year, there's a real incentive to build up inventory, because the more you build up inventory, the more dollars of fixed costs get tucked into work in process, and the more your adjustment to cost of goods sold reduces it and increases income. So this is our second concern about absorption costing, which is that it makes it seem like we are richer if we make stuff we can't sell. So I hope you found this analysis helpful, and I hope you'll look at the other videos. Thanks a lot. Bye-bye.